Pharmaniaga returned to the black in the first quarter of FY 2023, rebounding from its largest ever quarterly net loss of 664.39 million ringgit in the fourth quarter of FY 2022, in the absence of an impairment of COVID-19 vaccines and a write-down of goodwill for its Indonesian manufacturing cash-generating units. Still, the earnings of 2.6 million ringgit were 90.5% lower than the 27.7 million ringgit it reported in the first quarter of FY 2022. Revenue totaled 880.5 million ringgit, inching up 2.1% from 862.72 million ringgit in the immediate preceding quarter. The latest figure is down 8.5% from 962.2 million ringgit the previous year, mainly due to lower customer demand in both the concession and Indonesia segments. Pharmaniaga noted it also booked higher interest expense as a result of the hike in the overnight policy rate. In a statement, Pharmaniaga Chairman Izzadin Daud said the first quarter performance was encouraging and demonstrates its resilience and ability to overcome adversity. He said the PN17 company is on track to conclude its concession renewal by the end of next month and should complete the implementation of its regularization plan by the first quarter of next year. Supermax Corp remained in the red for a second straight quarter amid the worsening operating environment, with the continued fall in the average selling prices of gloves and escalating costs. The net loss of 39.9 million ringgit in the third quarter of FY 2023 was narrower than the 108.07 million ringgit it booked in the second quarter of FY 2023. The glove maker reported a net profit of 13 million ringgit a year prior. Revenue came in at 175.7 million ringgit against the top line of 174.8 million ringgit it recorded in the immediate preceding quarter. The figure was down 56.9% from 407.8 million ringgit in the third quarter of FY 2022. It declared an interim single-tier dividend of 3.5 cents. On its prospects, Supermax said in its bourse filing, the demand-supply equilibrium is showing signs of shifting favourably. Average selling prices have stabilized in general, although they remain close to the lows, while the stiff competition in the glove market is also seeing more smaller players exiting, while some manufacturers are scaling down or shuttering older plants and/or production lines that are no longer efficient. Nomura analysts reportedly say Singapore's casino duopoly, and to a lesser extent Malaysia's resorts world Genting, could suffer a short-term hit to their gaming revenues in the coming months as premium players increasingly fly to Macau. Citing analysts Tusha Mohata and Alpa Agarwal, Inside Asian Gaming said the number of people travelling to Macau from Singapore and Malaysia has been steadily rising since China's border restrictions were relaxed in January. Around 4,000 visitors from each country visited Macau in March alone. That's 43% for Singapore and 24% for Malaysia of pre-COVID levels. Many of these are likely to be VIP and premium mass players. The impact is expected to be somewhat more pronounced for Singapore casinos, given the Republic's more premium mix versus Malaysia's more domestic-oriented customer base. Still, any negative impact of this gross gaming revenue shift is likely to be minimized, as the initial pent-up travel demand to Macau stabilizes after the first few months. State-owned private equity firm Equity National, or Ekuinas as it's known, is said to be exploring selling shipping company Orkim. Citing people with knowledge of the matter, a Reuters report said the buyout firm is seeking as much as 1.5 billion ringgit and is working with an advisor on the potential deal. It said Kuala Lumpur-based Orkim has drawn interest from companies in the industry and financial sponsors. Deliberations are ongoing, and its sources reportedly said Equinas could decide not to proceed with the sale. Representatives from Equinas and Orkim declined to comment. According to Orkim's website, the company started as a shipbroker in 2004 and became a ship owner 5 years later after taking delivery of its first vessel. It is the only company in Malaysia to secure long-term contracts from Petronas and Shell for the domestic sea transportation of so-called clean or refined petroleum products. Orkim has a fleet of 18 vessels with an average age of 10 years and total tonnage of 153,637 deadweight tons. Malaysia Marine and Heavy Engineering Holdings, or MHB, saw its net profit rise by 30% to 3.54 million ringgit in the first quarter of FY 2023, as top line climbed 18.8% to 496.23 million ringgit on the back of higher revenue from the group's heavy engineering segment. On prospects, it said the reopening of China's economy, coupled with OPEC Plus's decision to cut oil production, should support strong oil prices for the year, which would most likely drive oil majors to ramp up capex spending. Additionally, the rapid growth of renewable energy and decarbonisation efforts driving global energy transition could present the group with business opportunities. Still, it remains cautiously optimistic on the outlook for the heavy engineering segment in view of the growing risks of global recession and geopolitical tensions. The group expects its marine business to remain challenging, mainly due to stiff competition from Chinese shipyards, while dry docking opportunities are becoming limited.